managerial account, that is break-even analysis. It is known as break-even point, or it is known as cost volume profit, or it may be called as sensitivity analysis. Then it can be called as any of these names. What is break-even? Any idea?
Is it where the cost is breaking even?
Eh? What is breaking even means?
Okay, so in economics, it's a point where basically
Yes,
the profits are zero.
yes. Profits are not zero. Basically, profit cannot be zero. If we are saying that organization is earning profit, means it is getting something over and above its cost. It is the point where there is no profit and no loss for the organization. That point is known as break-even point, whether in managerial accounting, whether in financial accounting, whether in economics, or whether in a layman term. Break-even means the organization is having no profit, no loss. That is the equilibrium point or break-even point. Now, what is exactly no profit and no loss? It means that organization is just recovering its expenses, recovering its expenses, nothing more than that. Recovering its expenses means, let's suppose any organization has incurred, let's say, total manufacturing cost of total manufacturing cost. Cost means expenses. Total manufacturing cost of dollar 10,000, and one product is produced. Now, when they go into the market and sell it, they got dollar 10,000 for his its sale. Now, what happened? The product is sold for 10,000 and its cost was incurred 10,000. Did anything come in the hand of the owner? No. Just it has recovered the cost. So here no profit, no loss will be occurred, and this product will be said as sold at break even. Then this is the concept of break even, that is we are recovering our expenses. Clear this point?
Yes.
Then
Yeah.
secondly, it is known as, it is the point where equilibrium occurs. Equilibrium means, equilibrium is basically physics term. Equilibrium means a form of static position. Means where two forces or two objects are in a rest or in equal position, or they are equal. So break even is also a equilibrium point, means here two things must be equal. What these two things are? Number one is total revenues and number two is total cost. Where there are total revenues, the total revenue and the total cost of the organization becomes equal, that would be known as equilibrium point, or equilibrium point is known as to be the break even point, because these two forces are at a rest, are at static position. Clear?
Yes.
Now the break even analysis in the managerial accounting, since it is the internal matter, so organization can use it in numerous analysis which they want to perform. So basically what break even helps organization in, it helps in different ways. Number one is for sales forecasting. Number two, it can be for the capacity or volume decisions. How much to produce? In economics, there was for whom to produce and what to produce. Here it is how much to produce. Now it can also be very helpful in deciding the product mix. Product mix means the different assortment, different portfolio the organization is portfolio of product the organization is producing or offering for the sales. Maybe let's suppose XYZ, maybe the Y product alone may be giving loss. But when these three products are sold, offered in the market altogether, the total revenue of the organization becomes greater. So it is advisable to sell Y, although it is incurring losses, since the total revenue is increasing. So this product mix is the decision about the product mix is also very important. Finally, it may be also helpful in the relationship between cost, volume, and profit, and pricing decisions. Then these are the some ways in which the break even can help in organization. Now, what would be the scenario to achieve or to calculate the break even for the organization? Let's do a quick, simple example. Let's suppose I am saying that my organization is currently earning sales of 10,000 and my total cost. Now, total cost means that is which cost? Total cost includes
Fixed costs and variable
yes,
costs.
fixed cost and that total cost includes also let's suppose right now total cost includes 8,000. So here I am earning a profit of what?
2,000.
1,000. Now organization want to see how much I want to sell. I should sell in order to achieve no profit, no loss, because there is recession in the economy, and I want to cut back my production. And obviously, when I will cut back my production, then my sales units will also suffer. So how much my sales can go further down till I earn no profit, no loss? That is the break-even point. So how it will be calculated? It would be look like that for break even we will do reverse working. For break even my profit should be what? Zero. my,
Yes.
my total cost would be 8,000, and so in order to recover this 8,000 I should have the sales value of minimum $8,000, so that I will be in a position to achieve the break even. Getting this point?
Yes.
Now, if the question is that how much my sales, how to what extent I can afford my sales to be dropped down. So from 10,000 to come at 8,000, I can afford sales to be dropped down by dollar 2,000. That is the maximum leverage available to me for achieve break even. If I goes down beyond 8,000 or beyond 2,000, further 2,000, then my company will suffer loss and I will not be in a break-even position, equilibrium position. Getting this point?
Yes.
Clear? Now, for analysis of break-even or for managerial accounting, what organizations do? Organizations break down their total cost in variable cost and fixed cost. Why? Because this fixed cost, we have learned a very basic characteristic that fixed cost is incurred even if production is zero. Means fixed cost cannot be avoided. Agree?
Yes.
This will be incurred. So it is the major consideration. If we cannot increase it, we cannot decrease it by our production, whatever the case is. The main concern is what? That is the variable cost. We can play, or we may say that we can either maximize it, we can minimize it, the variable cost of the production, not about the fixed cost, because it will be incurred whatever the case is. Done.
Yes.
So organizations make analysis in such a way. So organization makes analysis in such a way that they break down their income statement or sales analysis, profit analysis in such a way that first of all, sales would be taken. Let's suppose sales is dollar 1 million. Done. Now afterwards, they take into consideration the variable cost first. Variable cost is, let's suppose, dollar 600,000. Done. See what happened here. Sales less cost, that comes profit. But here, sales less variable cost, we cannot say it profit. Why we cannot say it profit? Any reason?
Because that's just one type of cost. You have to take in the total cost.
Yes, because this is variable cost. So the sales less variable cost, that component is known as contribution margin. Any idea of this contribution margin, or you are hearing it first time?
I think it's for the first time.
First time. Okay, let me explain it. Well, less sales, less variable cost, that will come contribution margin, and our contribution margin will be 400,000. First of all, CM, contribution margin, short form CM, is just like, I'm not saying that it is just like gross profit type. First of all, second thing is that contribution margin is referred as that the cushion, the leverage available for the organization towards its fixed cost. Means now if we have the contribution margin of 400,000, then how much we can afford towards the fixed cost. Getting this point? Means if our fixed cost is till 400,000, then it's fine for the organization. We will be at the break even. Then if we have the greater fixed cost greater than 400,000, then we will not be able to earn anything. And if our fixed cost is below that contribution margin, then the surplus will be known as our profit. It means that is the cushion or the leverage that can contribute, yeah, available towards fixed cost, that is known as the CM, contribution margin. So if I continue this example and if I write like this, that is our fixed cost, let's suppose is $250,000, then obviously now this variable cost and fixed cost, the total cost is now achieved. That is like this structure, and we have now finally we will have our net profit. And how much it will be? It will be, I think, $150,000, isn't it?
Yeah.
Done. So this is the managerial analysis presentation of the company's profitability, that has divided its cost into variable cost and fixed cost. Done.
Yes.
This
I have a
variable,
question.
sorry, yes.
So basically, if the company wants to break even, what do they target? Do they target the variable cost, like decrease it or increase, or is it the same?
They will target the recovery of fixed cost at least. It means, what does it mean? My next, we are coming on that.
Oh, okay.
Okay. What I was saying that, remember the company for the managerial analysis has broken the total cost into fixed cost and variable cost. That is the cost of production. And in many instances, we have other expenses as well. That is head office expenses that are not the form of production cost. That is the simple financial accounting expenses. They can be further analyzed into variable cost and fixed cost as well. Getting my point? Like the sales commission. Commission is on percentage basis. It will be in the variable selling and admin expenses. And the salaries are the fixed. So they will be included in the fixed selling and admin. Getting this point?
Kind of.
Then, so what I want to say that now if this happens, then this variable cost will also be divided into two. That is production and selling admin. Again, fixed cost will be divided into two, production and selling admin. This will come later. We will discuss at that point. Done?
Yes.
Okay, now what your question? What if company wants to achieve break even? Just work back. For break even, our net profit should be what?
0.
0. And our fixed cost will remain same. Done?
Yeah. Yes.
Now what this means? It means that in order to achieve break even, the organization must earn CM of rupees 250,000, $250,000. Done?
Yes.
Now, after targeting CM, now the organization will calculate what should be the percentage of variable, what should be the amount of variable cost, or what should be the amount of sales. Now, if one is known, the other will be calculated easily. Now, how it is done? How it can be done? Can you calculate the amount of sales to achieve break even? Yeah, the amount of variable cost to achieve break even. Basically, organizations target the amount of sales. They are concerned with the sales. So, can you calculate the amount of sales to achieve the break even?
Yes, you just take in the variable cost as 600,000 and then minus
No,
them.
we cannot take variable cost 600,000. How it is possible? Because to achieve break even, we will produce less. Our variable cost in total will also becomes less. And how much that we cannot say it with the surety. So this needs some calculation.
Okay, so basically you cannot just say that it is this. You have to do something.
We have to do something. And what is that something? It is something is that either we take the formula or we do like a statement. I will tell you both. Whatever the method seems easy to you, you can adopt that. What we do is we calculate the percentage basis. Always the sales or the top thing is considered as 100%. Sales is 1 million and variable cost is 60,000. So how much percent variable cost comprises? Can you calculate it?
I don't get it.
Okay, leave this. Just see this data. And I am saying that calculate variable cost to sales percent. Can you calculate this?
So 600,000 into,
Into
wait.
divided. Divided by 1 million.
Oh, okay.
Done. Multiply by 100.
Wait 1 second.
Now we are getting into the technical areas of managerial accounting.
Yes. 1 million divided by 600,000.
So variable cost
Okay, yeah.
to sales. To sales.
Okay. It's 0.6.
0.6 multiply by 100 in terms of percentage. We multiply it by 100, then it would be 60%. Done.
Yes.
Now, what is look like that? The sales are 100%, variable cost is 60%. Then our contribution margin would be what?
40%.
40% of sales. Getting this idea?
Yes.
Then means we can calculate it like another way, that is 400,000 divided by 1 million. It will give the same answer. We are subtracting it, or either calculate directly contribution percentage of contribution margin, that is 400,000 divided by 1 million. Done.
Yes. Okay, so sales is always 100% or it
Obviously
can be.
sales are 100%,
Oh, okay.
because this is the percentage of sales, this is the percentage of sales. So if you have studied in the statistics, that is the price index methods, chain base or base method. So sales are always taken as base, and base is the 100%. Done.
Yeah, okay, so just to clarify, 60% of the 100% sales is the variable cost, and then the 40% is
And the
the
remaining
contribution
40% is the
margin.
contribution. Done. Got it?
Okay.
Any problem?
Yes. No. But
Oh,
then how does it relate to everything else?
sorry.
How does it relate to everything else?
Everything else means that is fixed cost and net profit.
Yeah, like the break-even concept and calculating other things.
I am telling you. Right. Now what happened? Now see. Since we have established that our contribution, organization's contribution margin ratio, not amount, ratio, percentage will always be what? 40%. Then now
Mm,
we have got 250,000 of contribution margin dollar, and this represents what? 40%.
no,
Why?
because 40% is for the 400,000.
No, 40% is not for the 400,000. 40% is the organization's policy, that whatever we will make sales, rather 1 million, rather 2 million. If we make sales of 2 million, then the 40% of 2 million will be our what? Contribution margin. It is a uniform ratio.
Oh, okay, okay, got it.
Got it? Then if we are earning 250,000, this ratio, this amount is what? This amount is contribution margin. And contribution margin is what? 40% of sales.
Sales,
Then what would be the sales?
100%.
Yes, 100%. But how we will calculate it? Through this 40% of contribution margin that represents 250,000.
Mm-hmm.
Getting this point?
Yeah. Can you show it?
What? Can you
Uh,
calculate?
okay.
Can you calculate?
So it's just basically 250,000 into 100%.
Why 100? Your mathematics seems a bit weak, isn't it?
No, it's just I'm kind of getting confused. So we have 40% sales. Do we
40% not sales. We have 250,000 of CM. That represents 40% of sales. Getting this point? No,
yeah,
just a minute. Dollar 250,000 is equals to 40% of sales. Done. Now, what we are interested in? We are interested in calculating what? Sales.
sales.
Done. Let's suppose sales is X. So $250,000 is equals to 40% of X. X is
So do
sales.
you just use algebra here?
Yes, sort of. But once we are done, then it will be you can say that always you apply like this. So what would be the X? X would be X is equals to what? Dollar 250,000
Divided by
40%. 40% I can write like this 0.4.
yeah,
So we will arrive at sales
625,000.
625,000. Yes, good. This is the
Yeah,
sales.
this is way better because over there it was just arrows, so I got
Then
confused.
now what is the case? Now remember, always learn it. In order to calculate break-even point, we have to earn number one point. We have to earn CM equals to fixed cost, and then in order to find out the break-even sales, we have to do what? We have to do one thing. CM in amount divided by CM percentage. What we have done here. This is the CM amount, and this is what?
Yes,
CM percentage.
percentage.
Now you can easily work back on it. Now calculate 40% of 625,000. 625,000 into 0.4. Is it making 250,000?
Yes.
Then, and if we want to calculate the variable cost, it has again two methods. Just minus 625 and 250. The remaining we will get variable cost. What is it?
375,000.
375,000.
Yes, or you could use the percentage.
Obviously,
And then
very good. Now you can also check it with that. Make
yeah,
60% of 625,000.
yeah, 375,000.
Then got it.
Yes.
Any issues?
No.
No. Now
No.
what analysis can we infer from it? We can say that to earn a break even, to be at the not break even is earned. to be at break even, organization can go till from $1 million sales to $625,000. Means how much cushion it has between the current earnings and the break even earnings.
Okay, so the difference?
Difference, yes, it would be
Yeah.
$525,000. Organization can lose up to $525,000 in order to be at the break even. Any further loss in the sales will cause organization for suffering the losses. Then
Yes.
now it is in terms of dollar. What would happen if the organization asked that in order to achieve break even, how much quantity should I forego? What would be the opportunity cost of that achieving the break even for leaving that production? That is calculated through the number of units. If we have given per unit sales or per unit contribution margin, we can easily calculate it. Let's suppose $10,000 is the 1 million is the total amount that we have got from the sales, and per unit is sold at $10. So can you calculate the number of units? How much number of units sold?
It's just 100,000.
Number of units would be 100,000. Done?
Yes.
Okay.
And then in the other scenario,
Yes.
the amount of units sold would just be 625,000 divided by 10.
Yes. So it would be
Uh,
62,000.
yeah, 62500.
62,500. Done? And
Yes.
what would be the difference? It would be 52,000.
Yes.
Got it? It means that organization can reduce its sale by 52,500 units, or to achieve break even, the organization have to sell the amount or sell how much units, that is 62,500 units, rather 100,000 units. Clear?
Yes.
This is the situation of the simple break even right now. Done?
Yeah.
Okay, 5 minutes remaining. I need a break. You may also need a break. Come after 5 to 6 minutes. Done?
Yeah, sure.
Okay.